This video is a Bybit Earn tutorial. We're going to go through the entire platform and understand how it works under the surface. What are these different products and how are they actually generating potential yields for investors using them? I'll also go through some explanations about how they work as well. If you don't have a Bybit account yet, check the link below. You can get a deposit and trading bonus via that link. And I will leave timestamps to all of the different products down in the description as well. Let's firstly come to the Bybit Earn main page then. So once you do have a Bybit account, you can come to Finance, Earn, and then Overview right here. Now you do need KYC 1 to use any of these products. And if the products are not available in your country, Bybit is going to not offer them to you. So whatever is available for you, you can see dependent on where you are and what KYC that you have with Bybit. Now down here, you can see these different products. You have dual asset, you have staking, you have savings. Big differences between these under the hood. If you click on an asset, you can see the options that you can actually go ahead and use. Now, the first thing we need to do is explain the difference between savings and staking. These words are often used interchangeably, but they are incredibly different in how they work. Staking is a blockchain protocol. And so what you're doing when you're staking is investing in that blockchain and hoping that the blockchain is profitable by charging fees, and then it passes some of the profits back to you as a staker. This is a blockchain mechanism. So what you're doing is actually staking your assets on the blockchain. And what you're hoping is that each and every block, there are an amount of fees paid that actually create profits for that blockchain. Now you as a staker will take some of those fees back to yourself each and every block. And so what you're hoping is that the blockchain charges enough fees where it's actually profitable and then is passing some of those profits back to you in the form of a yield. That's blockchain staking. Very, very different to a savings type product, which is much more like lending. In fact, this is lending. What you're doing in a savings product is taking the value of your assets, you're lending it to someone on Bybit who is borrowing that from you and paying you an interest. Bybit take, 10% of the interest or whatever, they take a fee, but that borrower is borrowing your money and paying you an interest for it, and you're lending them that money. This has nothing to do with cryptocurrency at all. You're just lending money or whatever token it is to them, they're paying you an interest. Staking is blockchain based. Very, very different in the way that they generate yield and some of the risks involved underlying. Of course, you're hoping the blockchain will keep paying you that reward and you're reliant on the profits of the blockchain, whereas this is more about what is the demand for the asset that you're lending out at that current time. Let's come to Bybit Savings first then and how this actually works. Now, what we're doing with the savings product is lending someone else, another trader on the platform or market makers or whoever they are, we're lending them assets to trade with. They do this because Bybit has a lot of different markets, for example, derivatives markets and margin markets, where people literally have to borrow money in order to trade. Now, the way that this works is that Bybit has a liquidation engine. So you have a trader who is borrowing assets and paying interest for that to open up large trades. And if they are making losses, the Bybit liquidation engine is supposed to liquidate their positions so that they can pay all of their liabilities, which would be your lending them your assets. So you have to trust Bybit here that the liquidation engine is going to work and there won't be any bad debts. Or if they are covered by other insurance products. That's the first thing. So you have people that are borrowing assets and they're paying you an interest in the middle. So what we can do here is go to something like BTC and click action, and then you can see flexible savings and fixed savings. Under the hood, it's exactly the same. Flexible, you can withdraw at any time. Fixed term, you have to lock it up for that certain amount of time. You may get a slightly higher yield for that. So what we can simply do is press one of these to find out more. So we're going to press buy here. And all you have to do is just say how much that you want to loan out and then your yield for that. So we can press stake now, and there are different tiers. So you can see the tier 1, if you're lending 0.01 BTC or below, you get 1.5%, and then the APY goes down dependent on what tier that you're in. Now the APY or APR is a yearly figure. So if you did this for 12 months, you would get 1.5% over that 12 months, not per day or anything like that. You have to split this up by 365 or whatever to get a daily figure, or by 12 to get it a monthly figure. But with yield products, we always look at a yearly APY so that we can compare the yield across many different products and time scales. So what you can do is press, an amount that you want to actually invest. You can see we're tier 1 right here. So you get 1.5% APY, and the stake period is anything that you want because it's flexible. Now that APY can change over time dependent on supply and demand as well. You can choose fixed term, so that's 1.8%, also dependent on how much you're investing. So either 30 days or 60 days, stake now. You can choose that and the amount of BTC that you actually want to invest for that time. Estimated APR 1.8% for 60 days. After 60 days, that will come back out of the savings product, and then you can obviously reinvest if the product is still there. So what you're doing is actually lending some Bitcoin to other traders on the platform. Now, if we go down to US dollar tether, stable coins are very often lent out, and you can see that flexible savings is 5.5%, and then fixed term is actually below that here. So again, you're just lending dollars on the platform to someone else. The risks here is that, number one, you have your assets on a centralized exchange. Nothing wrong with Bybit. I've used Bybit for years without any issues, but they are a centralized exchange. And of course, that is, a risk. Centralized exchanges, you just don't know what's happening under the surface, not like DeFi where you're just relying on, smart contracts and open source code. The second thing is that you just have to trust that the liquidation engine is not going to have any terrible bad debts. For the most part, Bybit's been around for a very long time, and I've had no issues with them, but these are the risks that you have to make sure that you understand when you are using centralized exchanges and, savings or lending protocols. Now let's come to the dual asset product, which is where you see these really high potential APRs up to like 150%, right? So if you look at Bitcoin, you can see 5% to 135. For ETH, you're looking at 5% to 138. What on earth is happening to generate yields that high? Well, what we can do is go to dual asset for Bitcoin and press buy now, and then we can come to the dual asset page. Now, the yields that you're getting are described like an APY, but that's not really what's happening here. When you lend money out, that's very simple. They're paying you interest on what you're lending. This is not that. Dual asset is actually under the surface trading crypto options. Now, options are a highly complex derivatives product, and crypto has them. But what you're doing here is you're not lending money to anyone. You're not staking. You are actually potentially trading crypto, and you are being paid by a market participant to give them the option to do something. Now, options are incredibly complex, way too much for this video, but I'll explain them as simply as I can for this video. If you want to know more about them, you can see the crypto course here has an entire options section, what they are, how people trade them. As you can see, there are a lot of videos here in terms of option strategies and how they work. Too much for this video, but when you trade options, you can actually give someone else the option to do something in the future, and they will pay you a fee for that option. So what you're doing if you have either dollars or Bitcoin here is you can give someone the option to do something in the future, and they pay you money for that option, and that is your yield. So it's not savings or lending or anything. It is a short-term product where you're giving someone the option to do something, and you may have to trade and swap your coins. So if you have dollars, you may have to swap that into Bitcoin. And if you have Bitcoin, you may have to swap that into dollars, but you are always receiving that fee that they pay. It's actually called a premium. This is how it works. When you write options or you give someone else the option to do something, you receive a fee. They pay you a fee for the option, and that is known as a premium. The fee that you receive is the yield. And so as we can see here, when you see these crazy high APRs, what they're doing is taking a premium fee that you receive for maybe 1, 2, 3, 4 days until the option expires, and they're putting that as a yearly figure saying, wow, 150% a year. But you have to continually change the options and the contracts that you're writing in order to keep getting this yield. And there's many risks involved with that as well, including, like I said, having to actually switch between the two assets that you're giving people options on. Let's look at investing dollars firstly then, and how that would work to actually earn premiums. So this is what they call buy low. What you're actually doing here from an options standpoint is giving someone the option to sell Bitcoin to you at a price in the future. And what you're actually doing with options is writing a put. So you're giving them the option to sell you Bitcoin at a specific price in the future. And this is known as buy low because you're actually giving them the option to sell you Bitcoin at a lower price than it is now. Why is that? Well, if they were really bearish and they think that within a week the price of Bitcoin is going to drop a lot, then they can actually sell you at a certain price. So as you can see here, the price and the expiry are going to change the premium that they pay. Now, what you can see is that the closer the price is to the actual price, they have to pay you a much higher premium. So if you're saying in the future, I will pay 29,000 per Bitcoin, and you can sell that to me and it's going to last until this date, you have to pay a premium here, and that works out as 72% APR. Now, if we can see this one, this is a lower price. Now, if you're offering to buy in the future at an even lower price, that's not as in demand, right? So they're going to pay you a much smaller premium. If you're bidding a higher price, your price is closer to the current market price, they have to pay you a much higher premium because it's much more likely that that trade goes through. And so they're going to have to pay you that. So the price, the expiry, that all comes into how much the premium is. And this is worked out within the market. So what you can do here, we'll click on select on this one right here. We'll click select. What's happening is what you're saying is that in 1 day's time, I will definitely buy someone else's Bitcoin at 29,000. They're going to pay you a premium for this. So let's put $5,000 in here. Now, what you can see is that if the settlement price is less or equal to 29, what you actually do is buy their BTC. So if the price in the market is 28,000, that doesn't matter. You're still buying their Bitcoin at 29,000 because that's what you gave them the option to do. They'll sell it to you at 29 and go and buy it back in the market at 28, and they'll pocket the difference. So what you're getting here is buying that Bitcoin at 29, which you've agreed to do, and you always get the premium. So whatever the premium was that they paid you, you will get that too, as you can see here. If the price is below your strike price of 29, they will exercise because it's beneficial for them. They will be able to sell to you at 29 and go and buy in the market for lower than that. Now, if the settlement price, so that is the actual price of Bitcoin in the market on the day that this contract expires, if it's above 29, there's no way they're going to sell to you at 29 because they can just sell in the market for 30. So they're not going to sell anything to you. But as you can see here, you still get their premium because they are paying you that, and you always get the premium. They're giving you that for the option to do something. So what's going to happen is that you will get your premium and your fee. So you'll get that yield, which is around $10 in this case, and you'll get your dollars back, or you'll keep your dollars. You won't have to spend them. Now, this is, great, but obviously trading here is risk, because if the price is, 30K, you would have actually made money just buying Bitcoin and selling it later. But obviously, that's a different part of the equation. So as you can see here, this is an option to do something. There is risk involved. You may have to switch dollars into Bitcoin or Bitcoin into dollars, but you get a premium always, and that is the premium that you get. Now, what they do is they make this an APY, which is kind of misleading, right? You just get, for the extent of the options contract, you get that premium. And you can see the options contract lasts 1 day, 3 days like this. So the fee that you get is dependent on the strike price of the option and the expiry date of when that option is exercised and the probability of whatever's happening during that time. Again, very complex, and I go through it in way more detail in some other videos on YouTube, and the crypto course has the entire section on it. The other side of this trade is if you have a crypto asset already and you don't mind selling it in the future. Now, a lot of traders actually do this to create yield on their assets during times when the market is flat and not very volatile. So let's go through this. Sell high, invest BTC. So let's say you have Bitcoin in your account and the market is dead. There's no trading opportunities. Well, you can obviously trade options and receive premiums. So this works when you, obviously, if you want to keep your Bitcoin, you don't want to sell your Bitcoin, but you're just thinking that within the time frame, nothing's going to happen, right? It's not going to move up a lot. So what you're doing here is giving people the option to buy your BTC at a specific price. Now, as we can see, if the price is lower, you're getting paid a much higher premium for that, because what you're giving someone the option to do is buy Bitcoin at a cheap price. And so they're going to have to pay you a very high fee and premium for that. As the price moves upwards, so this is the highest price here at 30K. Currently, the Bitcoin price is underneath that. You can see the option here, or the fee, the premium they're paying you is very, very low. Why is that? Well, why would anyone pay you a lot of money to buy Bitcoin at a higher price than it is now? They obviously wouldn't do that. So what this is good for is if you have Bitcoin and you want to earn some yield on it, you can essentially write the contracts. They're called calls. So you're giving someone, you're writing a call, you're giving someone the option to buy from you at a later date at 30K, and they're paying you a little option for that. They're paying you a little premium. So you're receiving those premiums. Now, if the price of Bitcoin does go up within this time frame, let's say it's 31K, yes, you still receive the premium, but you've missed out on profits because you could have just held it and sold it for 31K, which is much higher than 30 plus the premium that you get. So it all just works out of what do you think is actually going to happen to the price, and are you happy potentially trading in the future if the price moves in a way that you don't expect, and do you want to take the risk for some premiums in the meantime? So that is if you have Bitcoin itself. You can write calls and give people the option to buy your Bitcoin at a potential price in the future and earn some premium fees in the meantime. Now we'll look at liquidity mining on Bybit Earn. Liquidity mining is something that you can do through Bybit. This is actually used on decentralized exchanges as well. So liquidity mining is something that happens on automated market maker pools. Again, pretty complex, but decentralized exchanges will use something called an AMM. And this is a mathematical model that tries to match buyers and sellers at a price where supply and demand meets. And so what happens here is that on a decentralized exchange, because there's no one in the middle, the protocol itself incentivizes people to put their assets into a liquidity pool, and you earn trading fees from traders. So what you're trying to do here is put two assets into a liquidity pool, and then you get a yield from people that trade those two assets and pay you trading fees. So as we can see, ETH, US dollar tether, Bitcoin, US dollar tether, many different assets that you can put into these liquidity pools. And you can see an APR here over 1 day or 7 days. This is again a yearly yield, but that's the average yield annualized over that 7-day period. Now, the yield is going to go up and down dependent on how many people are trading, because the more volume that is traded, the more fees that are generated on that capital pool. And so the yield can be a lot higher. So what you can do here, if you press add, you need to add two products or two tokens into the liquidity pool. And so you obviously need to go ahead and buy them both. So ETH and USDT, you need both of those. So let's say $1,000 here. It's actually going to work out exactly how much of each asset that you need. And what you can do is just invest one. I believe on Bybit, it will trade into the amount of ETH that you need, and then you can add that liquidity, right? So it's going to do all of that for you. You can see right here the amount of principal and liquidity, and the APR as it is of right now. You're going to get, this yield per month based on that. The more you add, of course, the more potential yield. So you're adding two assets in, you can add them here, you get the trading fees. If you want to remove them both and take them back out, you can do that. Now, with AMMs, there is something to be aware of called impermanent loss. I'll quickly explain it here. Again, it's a very complex topic, and I'll link some other videos that go through it in more depth. But essentially, what you need to know is if you put two assets into a liquidity pool at a certain price, right? So if ETH is trading at $1,800, you need to put $1,800 in and one ETH in, and that is a ratio. Now, if that ratio changes, right? So if ETH goes up in price to like 2,500, 3,000, the ratio between those assets has changed. Each time the ratio changes from when you put the assets in, you can see that there is something called impermanent loss. If the ratio changes a lot and then you take your assets back out, you essentially make a big loss from the difference in the price of those assets from when you put them in to when you take them out. Now, that potentially doesn't matter because you're earning trading fees on top of that. So actually the equation that you need to know is how much are you earning in trading fees, and then you have to minus any potential impermanent loss, and that is the actual profit that you make. So it's not just trading fees and yield. You have to think about a permanent loss as well. So essentially, if you're putting two assets in that are different, right, and volatile, so like ETH and US dollars, or Bitcoin and ETH, or Bitcoin and US dollars, they're volatile and the price changes a lot. So you are going to suffer from impermanent loss. There are calculators online where you can input potential price differences and work out what the impermanent loss would be. And so I'll link those below. But what I would say is, for the most part, these types of liquidity pools are not profitable. So for the most part, the impermanent loss that you will suffer is going to be greater than the fees generated from trading fees from traders, for the most part. Of course, it's very unpredictable, and so it's impossible to say what will happen in the future. But as you can see, the yields are quite low and the impermanent loss is going to be there. And so again, just make sure that, you know, this will or won't be profitable, dependent on what you think the price difference will be between the assets when you put them in and when you take them out. Bybit also run Bybit Launchpool, which is usually a way for new projects to launch a token on an exchange and drum up a little bit of interest. So if you go to Launchpool here, you may see on occasion that there may be a new token that is launching for the first time on the exchange, and they're going to literally give away some sort of allocation of it to people that use the launch pool. So usually you'll stake something like US dollar Tether or Bitcoin, and you can get a small allocation of the token of the project that's launching. It's really a way for new projects to just drum up some interest and some volume, or at least just tell people that their token is now trading on the exchange. So it's not really an investment, like it's not a savings product. You're not lending money, or you're not kind of investing and swapping assets. It's really just a kind of a marketing thing where you may get some new tokens of a new protocol when it launches on the exchange. Bybit also let us stake Ethereum directly through the Earn product, and this is actually the only real staking option that we have. There might be some other proof of stake coins added in the future, but as of right now, it's just Ethereum. So we can click ETH 2.0 liquid staking. Now what Bybit are doing here is actually making it easy to buy staked ETH. Now, staked ETH is a product from Lido, who are the most popular product provider here. So what Lido do is they take ETH and they swap it into the Ethereum protocol, and they get all of the staking rewards from the Ethereum protocol. They then put that back to the value of staked ETH. So if you own staked ETH, what you're doing is getting those staking rewards. So what we can see here is that you'd have to buy some ETH initially. So let's say 1 ETH, and it swaps it directly into staked ETH at a 1-for-1 ratio. The yield is paid into your account when you have that staked ETH at 4.79%. That was yesterday's APR. The APR may change depending on what the Ethereum protocol is paying at that time in yield. So actually what you're doing is just simply buying and holding staked ETH. Now, you don't have to use Bybit for this. You can actually do this yourself. So you can go ahead and use Lido. I've got videos on using Lido and how to stake Ethereum. I'll leave them in the description. To use Lido, you're going to need to use the blockchain. So you need a blockchain wallet, and you need to get Ethereum onto the blockchain, and you need to use the Lido protocol to swap that Ethereum into this staked ETH token, which gets the yield. So you can do that, no problem. But if people aren't comfortable with using the blockchain, they might not want to do that. Also, the Ethereum protocol is expensive to use, and if you have smaller amounts, the fees involved may just be prohibitive and not be worth it. And so that's why using Bybit, which is, you know, zero fees, may actually be beneficial to some people. The other thing with this as well is that Bybit let you use staked ETH as collateral if you are a trader. So if you trade on margin or leverage in derivatives, you can use the value of staked ETH as collateral to back up positions that you may want to trade. So there are some benefits here. And there are some trade-offs, of course, because this is centralized. So you have your assets on this centralized platform. So always to be aware of. But you can swap right 1-for-1 to staked ETH. And then when you want to swap them back out, you can just swap the staked ETH back into ETH right here and then do whatever you want with that asset. So what you're doing really through Bybit is using Lido staked ETH and that token, not using the Ethereum blockchain. If you want more specific info on all of these products and how to use them, that's what the Crypto Investor course is for, linked down below. Bybit deposit bonus down there as well. I'm James, it's MoneyTG. Cheers for watching, and I'll see you in the next one.